Good afternoon. Thank you all for joining us today. A bit of housekeeping to start. If you do have any questions as we're going through the session today, please use the Q&A function either at the top or bottom of your screen, and we'll get to them at the end. For those that don't know me, my name is Billy Mathews. I'm a portfolio manager here in our London office. I work with a lot of our US connected clients, and I'm joined today by the always brilliant Georgina, who is the head of international strategic advisory here in our London office. And she helps our clients think through some of the non-investment related issues around tax, estate planning, family governance, charitable giving, and really much, much more. And so what we're going to be touching on today, as the title of the session says, is the 7 pitfalls that we see most often in the kind of hundreds of conversations we've had with US connected individuals over the last 3 or 4 years. And so let's jump right in. Georgie, how are you doing today?
I'm all right. Very embarrassed by that introduction. Thank you. Very generous.
All true. So let's start with number one. This is a topic that affects everyone on this call, and that is compliance. So what are the pitfalls around compliance that we see?
So thanks, Billy. So from the US expat perspective, I would see the 2 really main pitfalls. One is really US compliance, and the other is what I always call trapped cash or lack of flexibility of funding. So the US compliance point really is just reminding US citizens that when they leave the US, they still need to file in the US. The US doesn't relinquish that burden. And we've come across, when we've spoken to clients, many sort of what we call accidental Americans who haven't realized that they need to file. And as we see when we talk about the other pitfalls as we go, being up to date in your compliance can be helpful sort of later on with your planning. So yes, number one pitfall is make sure you are filing in the right jurisdictions, and it may be more than one. The other pitfall I talked about was trapped cash. And that's really around some of our US expat clients who've come to the UK, and they've really come and sort of almost as a knee-jerk reaction chosen or elected to be taxed on the remittance basis. So they can effectively leave all their non-UK source income and gains outside of the UK tax net and just be taxed on their UK earnings or gains. All great, makes life very, very simple, but less simple when you've been on that basis for a very, very long time and decide that you might want to buy your house and all your funding is over in the US, and you've suddenly got to bring all that money to the UK, and there's a very big tax charge on the remittance, and it's too late to go back and amend your US tax returns and get credits. So you can actually then have some double taxation. So really my message is remittance basis is great. A rising basis may be appropriate, but the important thing to be doing is look at where you are in your life, assess each year, which basis should I be on? Does it make a bit more sense now that I've met the girl I want to marry, like you, Billy, that I switch to the arising basis? But just keep that in mind, because you don't want to end up with effectively all your wealth offshore.
Yeah, I think some of the ways that we like to think about it is there's a cost to flexibility, and in some cases it's worth paying a little bit of extra tax in order to maintain that flexibility. Just back to that point, if you are an accidental American, you haven't filed in the US, and you maybe have heard rumblings or know that you should have been filing, but you're a little scared. Is there something you can do about that situation?
So I'm going to coin your blog, the title of your blog, Billy. Yes, take your head out of the sand. The good news is, I think the IRS they certainly acknowledge it, maybe not expect it, but there is a streamlined procedure. So I think there is a formal procedure which many very qualified accountants can help guide you through, that can get you up to speed very quickly. And it's the kind of thing that can keep you awake at night, and you can have a panic attack about it because it just feels very overwhelming. But the US system is very used to this, and it is possible to get back on track with your US taxes without it being too painful.
Great. So we'll move on to the second point, which is one that I see on a daily basis, and we see with almost every single client that we work with, and that is problematic assets. So can you define what we mean when we say problematic assets, and then what are the pitfalls that you see around those problematic assets?
Sure. So the sort of pitfall around what we're going to talk about, problematic assets, is really punitive taxation. And the assets that spring to mind that we see most commonly are, investments in collective investment schemes. So, if you're in the UK, you'll see lots of UCITS funds, for example. If you're in the US, you'll see lots of US mutual funds. Both jurisdictions have very strict rules around investing offshore. And when they say offshore, they mean offshore to them, and they mean it in a total sense. It's not just about offshore in the sense of a tax haven or a low tax jurisdiction. And each jurisdiction, both the US and the UK, have rules around what happens to an individual if they invest outside the jurisdiction and how to make non-US or non-UK investments compliant. Unfortunately, being compliant for one jurisdiction does not necessarily make you compliant for another jurisdiction. So we will quite commonly see new arrivals in the UK from the US who have had a completely sort of tax compliant portfolio where they are invested in a lot of US mutual funds. They then come to the UK and we have a look at their portfolio, and those US mutual funds are offshore to the UK. And in order to be tax compliant, if you're offshore to the UK, you need to have UK reporting fund status. And quite often those US mutuals don't. The other issue is obviously that sometimes when you've been here in the UK for a very long time, you might then be invested in traditional sort of UK tax compliant investments, like a UCITS fund that is offshore, but it has reporting fund status. The Americans don't see it that way. They see that as what they call a passive foreign investment company. And so they will tax that incredibly punitively. So with a PFIC, a passive foreign investment company, you can in fact end up giving away most of your return back to the IRS. In the UK, if you haven't got a reporting fund, when it needs to be a reporting fund, you can end up paying income tax rates on your gain. So quite quickly, your investment return can get eaten into by the taxman. One of the other assets that we quite often see, maybe a bit sort of outside of the portfolio, are LLCs. So those are very common for some of our clients to come over to the UK. They might be some sort of family vehicle or even a business vehicle. And the issue with LLCs, for example, is that the UK sees them very differently to the US. They're very common in the US. Generally, they are what the US call flow through. So what we would think of as a partnership, it doesn't really exist as a taxable body itself, taxable person itself. But the UK sees it really differently. The UK sees this as a box, as a corporate, the same as a limited company, the same as an Inc. company. So the taxation treatment is really, really different. So if you are reliant on your funding from things like LLCs, then you really need to think about A, whether you can restructure your LLC if necessary, or B, how you can get those funds into the UK, because you could end up with some double taxation.
Yeah, I think another point on the investment structure is around retirement portfolios. So pensions, SIPs, IRAs. What is there to think about there? Is there any good news or silver linings in this this kind of mess that we often find ourselves in?
So, I mean, our experience has been that it is quite good news on the pensions. When we've worked with clients who have IRAs or who have SIPs, the general consensus with the advisors that we've been working with is that once a pension, sort of always a pension, as it were. It doesn't matter whether you're in the US or the UK with either your SIP or your IRA. The jurisdictions will say that it is a wrapper. The growth inside that wrapper is generally tax-free either in the US and the UK. Clearly, both jurisdictions have rules about when you start taking the funds out of those wrappers. And generally, it seems because they are wrappers, things like PFICs and non-reporting funds that we were talking about earlier tend to be a bit safer. it is just worth pointing out that pensions are a little unusual, I think, in the fact that their wrapper tends to be respected from what we've seen on both sides of the pond, because there are very common wrappers that aren't. So in the UK, we're used to ISAs, but that's a taxable account from the US tax perspective. So yes, you have to watch you've got no PFIX in that ISA. And likewise, a Section 529 account, one of the college accounts, I think they are in the US, it is not a protected wrapper from a UK perspective. So always check. It's very, down to how your tax compliance is going to be done.
Yeah. So let's move on to something that we see with almost every single American, and that has to do with problematic structures, and that is really around trusts. What are the pitfalls? Probably too many to list here, and too much complexity, but what are the main things that you see?
Yeah, so trust, as you said, comes up huge amounts. Trusts are a very traditional estate planning vehicle in the US, so we do see them a lot. I think just to sort of take the big picture, the real pitfall here is double taxation. And I think one of the ways to think about it is just to break a trust down, and effectively there are three key elements in the trust. There's the person who settles the trust, the settlor or the grantor, they might be called. There's the trustee, and there's the beneficiary. So from a settlor point of view, if you're going to create a trust, one of the big things to remember, if you're a US expat living here, you want to get on with your US estate planning, you might be thinking about the $11 million exemption, and you want to sort of start getting all your ducks in a row, is just check your domicile status. Because if you start settling trusts and you are UK deemed domicile, you are very likely to hit this lifetime chargeable transfer charge, which is a 20% charge on gifting assets into trust. And there is no credit for that in the US because there is no tax charge at the time in the US. So if you are a US expat living here, really check your domicile status before you embark on any sort of trust planning. If you're a US person living here and you're a trustee, make sure that you check whether you've possibly brought the trust into the UK tax net. So the rules on residency of trust from a UK perspective, will look at the residency of the trustee. To some extent, they'll look at the domicile of the settlor as well. But really, if you have been asked by your parents or your siblings to be a trustee, either for their will trust or something else, really carefully consider whether or not you should be taking on that role. Who are the other trustees? Is there a risk you could bring this trust into the UK tax net? If you do bring it into the UK tax net, then clearly the trust is now subject to UK income and gains tax charges. And it's really difficult under the treaty to get any sort of credit going between the two jurisdictions, because the US still sees this as a US trust subject to US tax. And lastly, and probably one of the ones we do see most frequently, is the position of the beneficiary. So a US beneficiary of a full-blown discretionary trust may well have always received distributions whilst living in the US with no further tax to pay because the trust has paid tax. Not so simple in the UK, because the UK will actually generally, more often than not, unfortunately, we've seen, want to tax that distribution if it's remitted to the UK, if they're on the remittance basis, or if as soon as it's distributed, if they're on the arising basis. So you really do need to think through, if you are connected somehow, either as a settlor, a trustee, or a beneficiary, if you're connected to a trust, it's really, really important to sit down with your advisor, come and talk to us, and we can help walk you through what we think this might mean.
Yeah, a lot of minefields with trust.
Yeah, and actually one of the biggest minefields is can be the habit you have in the US. Sorry, I'm looking at you accusingly, Billy, but the habit you have in the US of having these things called revocable trusts that you always think of as a nothing. They are not always a nothing in the UK. So when you are reviewing how you are connected to a trust, I mean that in the most broad sense, all trusts, including revocable trusts.
Yeah, being one of the few Americans in this office, I often take blame for the entire country. Um, which this comes to a related point, which is around what roles do you have? So what do you mean by what roles, and what are the various roles?
Yeah. So this is really the fourth pitfall. And I think the real pitfall here is about accidental residency. So a lot of what we see when we talk to clients is concern around their personal tax position, which is all very good and should always be addressed. But the other concern that creeps in is when someone comes to the UK, is there something else that they could be pulling into the UK tax net without realizing it? And we've talked briefly just before about your role as a trustee, and there's a risk there, but also think about, am I director of any company? Could I be moving central management and control to the UK? Could that company be UK tax resident? Am I a managing member of an LLC, which is seen as a company? Could I be bringing my family LLC onshore to the UK? So any formal roles you have as a charitable trustee, as a director, as a managing member, as a director in a general partnership, just think about, where am I? Should I be looking at this? And have I accidentally brought this into the UK, or what can I do to ensure that I don't bring this into the UK?
Yeah. What about if you have US-based parents, talking to them about their estate plan, if you plan to be resident in the UK for long periods of time? It's something that we find could be quite awkward, but it's an important point to raise in many cases.
Yeah, and this really sort of just links back to that trust point, because often trusts are used as part of estate planning, and often talking to the generation above you about their estate planning is a really sensitive topic. But with the pitfall of double taxation, I think there is a really genuine reason to start raising it, because whilst asset protection and inheritance and succession are really, really, really important, it is possible that things might need to be tweaked so that excess tax isn't being paid. It's not about sort of trying to do some cute tax plan, but it's trying to make sure that the right amount and no excess tax is being paid. And that may mean that you have to look at your children, if you're generation one, sitting in the United States with some children in the US and some children in the UK. You might need to think about different plans for them if those positions look permanent.
Yeah. Next topic is one that's very close to me, and we see a lot with Americans coming over thinking they're going to be here for a few years, and that is transatlantic marriages. What are the primary pitfalls and potential opportunities that you see with transatlantic marriages?
Yeah. Well, apart from having to listen to a lovely American accent, one of the big advantages or pitfalls. So the real pitfall from a tax perspective, I think, is a bit morbid, I'm afraid, and one that's hopefully a long way away, but that is around what we call a domicile mismatch. And that is that if one partner is a US citizen and the other partner is a UK domiciled person, then there is no spousal deduction or exemption available in either jurisdiction. So what do I mean by that? What I mean is that generally when you're doing estate planning in either the US or the UK, the general view is that inheritance tax is a liability that is only really paid on the second death, because when the first spouse dies, there's generally an arrangement that meets the criteria of the relevant exemption. That means that the entire estate goes to the spouse, inheritance tax free. That is not possible where you have this domicile mismatch, automatically at least. So if you do marry an American, or you marry a Brit, American marries a Brit, then you do need to think about, when you're rewriting your wills, and you do generally rewrite your wills on marriage, how those wills should be structured to take account of the fact that you may not have the same domicile. Do you need a special type of trust in your will if you're a US person called a Q dot? Do you possibly have to raise the prospect of making a domicile election if you're in the UK at the time? So there are things that can be done. It's just that you do need to think about it. The other point, which is slightly less morbid, but and a happier point, is thinking about how you buy your property. If you've got people from two different jurisdictions, So one of the lovely advantages of being in the UK on the capital gains tax side is that we have an exemption from gains on your principal residence, which is really valuable if you're looking to move up the property ladder. The US doesn't have that exemption. The US has at the moment a capital gains tax exemption for a gain of about $250,000, I think, on your main residence. So there can be quite a substantial mismatch in your main property. So a lot of clients will think about, if I'm going to buy a property with my American spouse, who should own that property? And quite often, and it's quite an entangled conversation, it can be depending on who's putting in what sort of money and things like that, but it can be quite helpful to think about the non-American holding the real estate.
Yeah, often connected with marriages is children, usually not forgotten, but in many cases they seem to be forgotten in this context. What do we see there?
Yeah, so children, yes, the biggest thing is to remind them that they are American, if they're living here, and it goes back to that first pitfall really about compliance. It also goes back to that pitfall about problematic assets. If you are the Brit and you've got dual citizen children who may be inheriting your estate, and that estate has UK reporting funds in that look like PFICs from an American perspective, you need to think at the appropriate time about making sure that your estate is not problematic from a US perspective and that your children are filing correctly.
Sage advice. Let's move on to a more positive, hopefully positive topic, and that is charitable giving and philanthropy. What's the pitfall, and really what is the solution or the opportunity?
So the good news is that both jurisdictions look very happily, obviously, on charitable giving. It's a good thing to do. And I'm sure our clients are aware there are tax advantages or tax deductions that can be got when you give to charity. The issue is, again, quite a territorial one, and it's a bit similar to the way that the jurisdictions look at what's offshore. But the deductions are effectively only available in the US if you give to a US charity, and in the UK if you're giving to a UK charity. So depending on the basis on which you are taxed and where you are looking to get your deductions, it might be that to maximize the efficiency of your charitable giving, you are looking to what we call dual registered charities. So charities that are registered in both the UK and the US. You do need to be a bit careful because some charities will have arms. So they'll be the US Friends of or the British Friends of, but they may not be dual registered. There is an easy solution to that, and we work with many clients who have these donor advised funds, and donor advised funds can be dual registered. So you can make an annual big gift to your donor advised fund that is dual registered, and then throughout the course of the year, make individual grants from that donor advised fund onto charities.
Yeah, and one of the benefits to tie back to that problematic asset point is it can be quite efficient to donate either PFICs and or US listed funds that do not have UK reporting fund status into a dual qualified donor advised fund as a way to get the tax deduction and get rid of the problematic asset all in one fell swoop. So that is something to think about if you have some of these problematic assets that we talked about before. So on to the final and seventh topic, and that has to do with both leaving the US formally by expatriation, but as well as leaving the UK either for personal or taxation reasons. What are the key snags or pitfalls around that?
Yeah. So if you've had a complete sort of headache from all the tax compliance living in the UK and everything else, you might just sort of want to go back to America. If you leave the UK, whilst it is generally very clean to leave the UK, UK taxation is based on residency, not on citizenship. The UK does have rules that effectively cast a shadow over you whilst you have left the UK and where you may return to the UK. So we do have rules called temporary non-residency rules, which mean that there is a recapture of tax if you leave the UK and come back within a certain period of time. Generally, you have to be out of the UK for about 5 to 6 years to make sure that that doesn't happen. And also, if you've triggered deemed domicile status here, that has a bit of a hangover when you go back to the US. So don't leave the UK having triggered deemed domicile and the next day start setting up your grantor trusts in the US, for example, as you may find that you are in fact still UK deemed domicile. So just because you're leaving, you might need one last piece of advice from your tax advisor to make sure that you are clear on when are you completely clear from any UK tax liability and how you should manage your finances on the off chance you might return to the UK. Now, talking about leaving America, so you might decide you've met your British spouse, you're here, you're never going to go back to America. It's time to expatriate. I mean, we did that lovely session with Jamie Macklemore from Withers a few weeks ago, which for anyone who wants it is available. The thing to bear in mind with that is, apart from one specific category, you know, there can be an exit tax when you leave the US, which is effectively a deemed disposal of your worldwide assets at market value. And that tax charge is, I don't think I have found a jurisdiction that recognizes that tax charge. So if you left the US to stay here, I don't think you would get any form of credit for that when you eventually did sell the assets, for example, or anything like that, or an uplift in base cost. So there is an exit tax, and there is also a training tax if you're covered, if you're what's called a covered expat on gifts back to US citizens. The advantage, though, if you haven't fallen into our first pitfall of being up to date on your compliance and you are a dual citizen at birth and your dual citizenship was US, UK, and you're living here in the UK at the time you expatriate, is that in theory there shouldn't be an exit tax charge because there's a specific exemption, but it is reliant on you being compliant and up to date, and it is reliant on you living in the other jurisdiction that you are dual citizen in.
Wow, that was a whistle stop tour of all things US UK. We do have a few questions, so maybe we'll just jump to them. Again, if there are any questions that anyone has out there, or any additional questions, you know, feel free to put them through, or alternatively, you know, shoot Georgie or I a note after this, and we can try and get to that. The first question is kind of back to that compliance point, and that is around US and UK tax and kind of law advisors. You know, should you have someone that does both? How do you see you know, our clients, and how would you advise our clients to think about that?
So I think we've seen a range of options by clients. You know, that there is a community in the UK of US, UK advisors who are dual qualified and who can do both returns and provide advice on both. They are, you know, it's an incredibly holistic experience because they can see everything and they can think about it all together, and it's very fluent. It is expensive, but it does mean that I would have thought the chances of anything falling through cracks is minimal. I think we've also seen clients who've come to the UK who have a very trusted US advisor that they've worked with for years. And we know many UK advisors who are very happy to work with existing US advisors. The only issue can be is that a lot of US advisors are less fluent with the international aspects of having an international US client. And so, although they may know their stuff incredibly well, it can become a bit tricky when you're then asking your US advisor to start sort of filling in tax returns that are going to be based on credits or tax treaty claims. So I think it's always wise to check with your existing US tax advisor that they are happy to continue to be your US tax advisor and do your compliance when you're in the UK. But there isn't the perfect sort of answer. I think it depends on everybody's situation. But the one thing to bear in mind is, you know, this is a costly world. It's an expensive world, whichever way you go.
Yeah, great. So another question we received, this is a bit more specific. But for someone who's on the remittance basis, is planning to be here long term and eventually move to the arising basis or the worldwide basis, is there anything they can do from an estate planning perspective to set up something for their dual citizen child?
Is there anything they can do? So it is really quite tricky. One of the things that we have looked at is it depends on the age of the child. So because a lot of the problem with the US, sorry, my earbuds, a lot of the problem with the US UK tax is that we don't have a crystal ball. So my thought would be to start thinking about whether or not you can start pushing that decision about, are you going to have a full US trust, for example? Do you have time in your deemed domicile timeline here to wait until you can set up some sort of US trust, if that's the way the children are going to go? Let's say your child decides that they're going to go to the US for university. Is it possible that you can buy some time to get a bit more visibility on that? Is it possible that you can think about using things, for example, if grandparents are going to be gifting, that you could hold things on trust, on a bare trust for a minor, so that grandparents at least can start utilizing their exemptions if they're in the US and that's part of what's going on. And if you are in a full-blown sort of everybody's going to stay in the UK possibility, are there any sort of family investment vehicles that you can possibly begin to look at where the treatment between both sides of the Atlantic is a bit more even? And I suppose in the context of the family sustainability series that we were doing, and we were looking about structuring for families, one of the vehicles we did look at was family limited partnerships. And I think, we have seen some US connected clients begin to look at those as vehicles where succession planning can happen sort of on a fairly even basis between the US and the UK. But I would add, I think it will depend on the assets. It depends on your timeline, but very happy to chat to anyone who wants to sort of throw around some ideas in a bit more detail.
Yeah, okay, we just had another question come through. If you're moving to the US, one is a dual citizen and one is going to get a green card, and you're buying a house in the US, how should you think about the ownership of that house?
So I think it's a slightly different question, because the sale of that house is going to be subject to the US tax regime in the first instance, because it's US situs property. So the US is always going to want to tax that house. So I don't think the conversation we were having about the fact that there's an exemption in the UK comes into it, because if you are in the US with a green card and you're going to be taxable in the US, and you're a dual citizen who's in the US, so you're always going to be taxable, you are always going to be subject to US tax. So I don't think in that scenario, and I'll check, but I don't think that there is a way that the UK exemption can help you, because you are both, you're talking about US situated property where the US has first rights under a double tax treaty anyway to tax, and you're talking about people who are both in the US tax net as green card holders or as citizens.
Yeah, and if you're filing jointly in the US, then you, and both of you were US tax resident, you each get the 250,000 exemption from gains from a US perspective, so you'd get 500,000 total. So having, I would think, having it at least some portion of it in both husband and wife or both spouse would make the most sense there.
And assuming you're not in the UK at the time that you sell it, the UK, even if you're a UK resident, even if you're a UK citizen, even if you are a UK citizen, but you are not UK resident, you're in the US at the time that you sell it, and you're not under the temporary non-residence rules and things like that, the UK ceases its taxing rights effectively on residency. So the UK will be much less interested in the sale of a US property with a non-UK resident.
Great. Well, if there's no other questions, I think that's all we have today. So I wanted to thank you, Georgie, for your expertise, and thank everyone else for joining us today. Again, if there's any follow-up questions or you'd like to have a quick chat with Georgie or I about any of your kind of specific situations, feel free to reach out directly to one of us or to your other friendly Broad Advisory contact. So thank you all for joining, and have a good rest of the day.